I'm Michael Fox, and this is the Prospector podcast. And I have joining me returning guest, Jeff Christian, the founder and managing partner of the CPM Group. Welcome, Jeff.
Thank you for having me back, Michael.
Yeah, I've been wanting to have this conversation for quite some time. And you are the person that I think is best served to have the discussion with. I want to talk in general about the Comex and how it works, why it's there, and the whole thing. There's a lot of misconceptions, a lot of misunderstandings as to the Comex, its functions, from its general purpose right down to how things even happen on the Comex. And quite frankly, it leaves me shaking my head oftentimes at why and how people end up with these misconceptions, as it probably does you as well. So let's start off with the basic. What is the Comex and why is it even there?
Yeah, we'll talk about the Comex and we'll probably talk about the Comex gold contract, but a lot of what we're going to be talking about actually applies to all commodities futures markets, all commodities futures exchanges, right? But the Comex exists to allow commercial entities to offset and find someone else who would buy their price exposure from them, right? And I think one of the things that people don't understand from the outside is that when we talk about who's trading on the Comex, these are companies that are registered with the Comex, and in some cases they're trading for their own account, but in many cases they're trading for their clients too. So they'll have short and long positions. But commodities exchanges were created, I think, 600 years ago in the dawn of international trade, when European physical commodity merchants would want to import goods from Asia and sell them in Europe. So they'd say, okay, I want to rent a ship and hire a crew and outfit the ship and crew, and then put a lot of money or other tradable goods on that ship and have that ship sail around the Cape Good Hope, where a lot of ships sink, go into Asia, go into countries that are sometimes hostile to European entities sailing into their harbor, and trade, buy a lot of goods, bring it back around the Cape Good Hope, and if they make it back to Europe, we can sell those products in Europe and be rich. So the first thing is, where do we get the money to rent the ship, hire the staff, outfit it, and supply them with capital to buy these things? And the way you do that is you find someone who is willing to loan you money and take on that price risk and that exposure. It's not just price exposure, it's the risk of losing everything if the ship goes down or if pirates capture it. That was the creation of futures markets in Europe, and at the same time in Japan and other parts of Asia, where merchants, physical merchants, would say, I need to offset my risk to this commodity. Who would be willing to buy my price risk? And what they found were investors, and some people call short-term investors speculators. They found investors and speculators who say, well, I could make a fortune if I give you money now and the ship makes it back. So that was the creation of a futures market. And that's how futures markets came to be. So we hear people say, well, if you're not going to take delivery or make delivery, you ought not to be allowed to be involved in the futures market. Futures markets are not there primarily to transact physical deliveries. Futures markets are there primarily so that commercial entities can transfer their price risk to investors and speculators who are willing to invest in and speculate in that price exposure. And that's why those things exist. If you didn't have those investors and speculators who are willing to buy price exposure, not metal, but price exposure, if you didn't have them supplying the capacity for the commercial entities to hedge and protect themselves from price moves, the physical market would not function in any way nearly as efficient as it has the last 600 years.
Okay, so that's the history of why we have futures markets.
Let
And
me add one. Let me add one thing. If you look at global GDP growth, and we have it back to the year zero, I don't know who came up with it. If you look at global GDP growth, it was 0 to 1% per year from the year zero until around the year 1500. And then it started growing, and it started growing at 2%, 3%, 8%. But over the long period since 1500, say 2 to 4%, 2 to 5%, right? Futures markets and other financial and physical and technological innovations allowed for people to advance their lives and improve their living circumstances substantially after 1500 years of being flatlined.
yeah, and trade was a big part of all of that.
Absolutely.
So that's the big picture of the future market, why it's there, why we allow investors and speculators into the market, and that it's a conduit to make trade move more freely between, buyers and sellers, essentially.
Or
Uh,
producers and users. Yeah.
yeah. So for the purposes of the rest of this discussion, I want to narrow it down to a single commodity. Let's use gold as the example, just because if you deal with the whole broadness of it, it could continue to confuse people. But the things that I hear people tell me, and it's the first point is actually kind of two things that kind of mesh in together. Firstly, they confuse bullion um, that's on the Comex with the bullion that a retail investor would buy. Like a retail investor goes to the bullion dealer, they buy coins, rounds, or 5 or 10 ounce bars. Where on the Comex, they're actually trading when they take delivery. They're trading in 1,000 ounce bars, or sorry, 100 ounce bars, right?
Right. 100-ounce bars.
100 ounce bars that are being dealt with by governments, banks and large investors. So there's this mismatch between those two things. And the retail investor and the people that are investing on the small scale think that all the Comex is doing is they're doing what they do on a small scale, but on a bigger scale. And the reality is they're not actually trading the commodity, they're trading contracts. They're trading promises to sell the commodity to a buyer. And that's different than walking into a gold shop and actually buying around, where you're actually buying a product that actually ultimately comes out of the Comex process, but it needs to go to a manufacturer and makes the coins and the bars. And that's why, it's never the spot price for gold that you buy these at, it's spot plus whatever it is at that given moment. Am I correct in this
Yes, you
assumption?
are. Yeah. It's the difference between a wholesale and a retail price. Yeah. Yeah.
Okay, so let's go back to the Comex then. The other misconception that I seem to hear constantly about trading on the Comex is that the investors and the people at a retail level in general are under the assumption that it's like a game of musical chairs. You know, you have the music stops, everyone needs to find a chair. And the reality is, a lot of contracts that are being traded on the Comex don't stand for delivery and never will stand for delivery. So if somebody is, you know, bought a 100-ounce bar on the Comex, they don't necessarily want to take that 100-ounce bar. So let's deal with the mechanisms of how those contracts are dealt with and settled on the Comex, because that seems to me as one of those scenarios that's causing a lot of confusion with people, because there's way more ounces in contracts that are being traded at any given time than actual ounces going into the Comex.
Right. Again, the COMEX or any futures contract or any futures exchange exists primarily to allow commercials to hedge their price exposure. And they do that by attracting investors who want to buy exposure to gold prices, not necessarily buy gold. If you want to buy gold, yeah, you can go to a dealer and you can buy 1 ounce coins or kilo bars, or you can buy, wealthy investors will buy 100-ounce bars and have them stored someplace for them. And you'll pay 100% of the value of that metal. But the investors who go into the futures market and say, you commercial entity, you want to hedge your price exposure. You're long gold in the physical market. You've bought it from mining companies or smelters or refiners, and you're leasing it out to jewelers and electronics manufacturers and others. And you've got this price exposure there. You've paid for it, but you haven't sold it. You'll sell it when your manufacturing clients buy it from you at the end of their manufacturing and sales process. So you have this massive price exposure. I'm willing to take it, but I want to take it on special terms. I don't necessarily have to buy 100% of the material. And B, I'll buy it on a futures contract, basically an insurance policy for you. And I will put up 10 or 15%, depending on who you are. You might even have to put up 20% margin. So I'll put up 15% of the value, but I'll have exposure to 100% of the price change. So that's a big advantage for me if I'm a short-term investor who doesn't necessarily want to buy physical gold and pay 100% of the value. I'm an investor who wants to buy exposure to rising gold prices, right? Not physical gold. Then I can do that on a leveraged basis by putting up 15% of the value and going long a gold contract on the Comex. And all I have to do is make sure that I have the financial wherewithal to meet that commitment should I have to buy the 100%. And the system assures that through a variety of regulatory oversight and compliance and margin. So that's the mechanism. And, those investors are critical there because they provide the capital that allows the physical market to operate in a more efficient way.
Okay, let's get into the minutia of how the Comex acts as a middleman. Let's use gold from the miner and to the jeweler as an example. You talked about them buying taking the contract for delivery of the gold and then leasing it to a manufacturer such as a jeweler. Explain that a little bit more in depth so that people will have a better understanding how that process works.
Okay. Yeah. Most people live on credit. I'm one of those few people who has no debt, but if you're a mining company or a smelter or a refiner, let's say you're a mining company, you need cash to operate your mine, develop it, pay your people, buy reagents, buy equipment, buy replacement parts, et cetera, et cetera, et cetera. You need money. So what you tend to do as a mining company is say to a financial intermediary or a smelter or a refiner that serves not only as a smelter or refiner, but also as a financial intermediary. You say, I want to sell my gold to you as soon as I can. And the financial intermediary will say, fine, as soon as it's not in your control, I will buy it from you. So the day you ship your gold from your mine, and it might be in doré form, which would be like a 80 or a 90% gold and silver semi-refined product that goes to a refinery, or it could be contained in concentrates that have, copper, lead, zinc, and other metals in it too. And maybe has a gold content of, I don't know, 10, 20%, 40%. I will buy that gold from you as soon as you don't control it, right? It's not that I don't trust my clients, but I don't trust my clients. So as soon as it leaves your mine gate, you've had it assayed, you've had it sampled, we have an idea of how much gold's in that shipment. You call me and you say, okay, Brinks or Malka Almet or some other courier, secured courier, now has this gold and this shipment, and it contains X ounces of gold at today's price, $3,425. You'll pay me 80% or 90%. And then when it's finally refined, you'll settle up the remainder. And that gives me, the miner, the cash I need to operate my mine. Right? So that's how the miner looks at it. I need cash as soon as I can get it. I can only get it when the stuff is no longer in my possession. So I will sell it, in essence, selling it forward before it's refined, as soon as it leaves my mine. At the other end of the spectrum are jewelers and electronics companies and a host of other companies that make stuff. They take refined gold and they convert it to grain, or they melt it down and make sheet or wire out of it, or they dissolve it and they make plating solutions. And then they sell that to companies that make parts for electronics companies and parts for jewelry companies and parts for other companies that use gold. And then they sell it to semi-manufacturers who sell it to jewelers, jewelry manufacturers, or electronics chip manufacturers, or somebody else. There's a series of companies. Most of those companies are privately owned, or they're very small public companies that don't have ready access to capital or loans. So a lot of jewelers, if they say, I'm going to borrow money, what can I borrow money at? The lenders will say, well, 18%. Credit card fees. Okay, well, that's kind of painful. Then a bullion dealer comes along and says, I will lend you the gold at 3% or 5%. It's like, okay, 5%, 18%. I'll borrow gold. I will borrow it. I will pay 5% on it, and it will be in my factory, and I can use it to make the jewelry or whatever I'm making. And as I sell and ship my product, I call up my bullion dealer and I say, I just shipped product with 100 ounces of gold in it. I need to buy that gold, and I need to tell my client what I'm going to price it at. The dealer, the bullion bank or bullion dealer, says, okay, the price is $3,425. For you, it's $3,428 plus the 5% interest that you owe me because you've had that gold in your inventories for 30 days or 60 days or whatever it is, right? So then the jeweler or the manufacturer can say to its clients, okay, here's the price for the products I made for you and I'm shipping for you, and here's the price of the gold content. Then they buy that gold, and the dealer tops off the inventory the working inventory that they are lending to that manufacturer, right? So the manufacturer can't go to the mining company and say, hey, I'd like to buy gold directly from you. The miner would say, fine, you're going to buy semi-refined gold at my mine in Australia or West Africa or South Africa or Bolivia, and you're going to have it smelted and refined and made into product, and you're going to pay me 80% the day you pick it up in Africa. And the jeweler says, no, I'm not. And the mining says, well, I'd like to sell directly to the jeweler. And the jeweler says, fine, I want refined gold in sheet or grain or plating solution form at my factory, and I'll pay you 3% interest until the day I sell my product, and then I'll pay you for the gold. And the miner says, no, you won't. So they both need a financial intermediary to basically broker that business, right? And make that business doable without being prohibitively expensive. That financial intermediary needs to protect itself from the volatility of the gold price. I might be buying gold at a mine today that is $3,425 an ounce, but I may not be selling that stuff for 2 months or 6 months, by which time the price could be back to where it was 6 months ago, which was $3,000, in which case I'm losing $425 an ounce. I have to protect myself from the volatility of the gold price. And the way I do that is in the futures market or the forward market or the options market. Now, who's going to take that risk? An investor or a speculator, right? Without the investors, without the speculators, without people saying, I don't want gold, I just want to have exposure to the potential for rising gold prices. Without those investors and speculators, the physical market is extremely inefficient and extremely more costly to operate.
Yes, it is. And here comes the other comment that I hear on a regular basis. How come one of these financial intermediaries can be both long and short in a commodity at the same time?
Right. I mentioned earlier that the companies that participate in the Comex are registered Comex participants. And it's funny because like during the silver squeeze and the Wall Street silver scams, there were people on the internet talking about how it's outrageous that you have banks and dealers listed as commercial entities in the futures markets. You know, the commercial entities should be miners and jewelers. Well, the miners and jewelers don't trade futures and in many cases don't understand the futures and markets at all, or very little. The entities that trade on the Comex are financial intermediaries that are registered with the Comex. And you'll take the XYZ bank, because I don't want to pick on anybody because they'll say that they're my client. The XYZ bank has a trading capacity on the Comex gold contract. It will trade for its own account, hedging its own exposure to the physical gold that it owns and has leased out. But it also will have clients that will say, oh, okay, I want you to trade for my account. So a mining company, a smelter, a refiner, a jeweler, they might come to them and say, okay, the miner might say, I want you to trade for my account. I would like to go short. I'd like to sell my gold today, and I'll use the December price, which is $50 higher than the spot price. And you know, by December, I'll have refined metal. I'd like to protect myself today by selling short the December contract, right? A jeweler might say, I need to protect myself from rising prices. So yeah, I'd like to go long the December contract. Investors will come to them and say, I'd like to go long, I'd like to go short, right? So that XYZ bank is trading on the Comex, not only for itself, but for an untold number of clients, some of whom are commercial, some of whom are producers or refiners, some of whom are jewelers or users, and investors, investment funds, and others. So a XYZ bank or a ABC trading company might have all kinds of long and short positions that it trades on the futures contract. And it could cross those on its own book. But by going onto the futures contract, it's trading with a clearinghouse. The clearinghouse says, you, the XYZ bank or ABC trading company, you have proven to us by putting up margin that you and all of your clients have the financial wherewithal to meet their financial commitments of being long or short the Comex gold contract. The XYZ bank, ABC trading company, will in turn go to their clients and say, you need to put up margin so that I can say to the clearinghouse, hey, these guys are good for it. So that's one of the protections you got, and that's one of the reasons to use the futures markets. If you go back to the financial crisis of 2007, 2011, it was actually a series of crises. In 2008, the interbank lending market froze up. No one knew what the value or creditworthiness of banks, individual banks were. So it was very difficult for one bank to say to another, hey, I want to trade with you in the forward market. And as a result, they turned to the Comex because they had a clearinghouse there that protected both parties. And if you go back to late 2008, 2009, there was this enormous surge in the trading volume on the Comex gold and silver contracts. And people who didn't know what they were looking at, the demagogues and the hawkers of precious metals, were saying, oh my God, look at what's going on the Comex. You know, this is like some sort of scandal. These guys are whacking the market or whatever. But in reality, what it was the financial intermediaries in the precious metals markets, and actually across all financial assets and commodities, didn't have the credit worthiness to trade on a principal to principal basis. So they started moving to futures exchanges that had clearinghouses. And if you looked at what happened after 2008, financial regulators around the world got together and said, clearinghouses saved the world from a depression. We need to go through all financial markets and say, what can we do to have clearinghouses clearing these transactions? You know, and that's really the key to it all.
We use the terms regularly long and short in the commodities market. And I don't know that the actual investors understand those terms as to what they mean. And so if somebody's long on the commodity, I'm assuming that they're a buyer and a short person is a seller, and they're hedging their price position accordingly. Have I got that more or less right, or am I backwards?
You're right up until the subordinate clause. Yeah. A long is someone who has bought a futures contract or an options contract, and a short is someone who has sold them. Some of those buyers and sellers are hedging their physical market exposure or their exposure in other markets. They could be trading arbitrage between London and New York or New York and Shanghai. Some of them are hedgers, but some of them are not hedgers. They are taking what some people call naked or open positions as an investor, right? And the regulators over the last 25 years have worked very hard to try to find mechanisms to allow for market participants to very accurately discriminate between this is a hedge, a bona fide hedge, in the words of the market, and this is a investment position.
Let's look on the short side of the market then for an example again. Most investors at the retail level that I work with, when they hear the term short seller, what they imagine is the short selling function that you would see on a stock market as an example. So if I want to short ABC company, I have to borrow shares in ABC company and I sell them at a price. And then depending on my credit worthiness, I have to buy those back before I hit a margin call. And I'm essentially betting that I can buy those shares back at a lower price and hence make a profit from where I sold them and where I have to buy them back and return them to the person that lent them to me. On a commodities market, a short doesn't function that way. Am I correct? Like,
Right.
if we're
Correct.
talking about gold, they're not borrowing gold in order to take a short position. And that's what a lot of people seem to think it happens.
Exactly. It is true. It is exactly true. And it's actually, yeah, there are people who hold themselves out as the definitive source for gold data, and they include hedges as a source of spot physical demand because they assume that someone is borrowing or buying gold to cover their hedge position. But that's not the case. In the commodities market, you do not have to borrow the underlying asset to short it. You can simply say, I want to buy a short contract, or I want to go short one contract, and you don't have to have the commodity behind it. What you do have to do is put up some form of collateral margin, and that margin can be the commodity. Hey, I have depository receipts. I have gold in a Comex recognized depository in New York or Delaware or Connecticut. And here's my depository receipt. I'm giving it to the clearinghouse as collateral against my short position or my long position. Or I can put up T-bills, or I can put up cash. So you have to show to your broker and to the clearinghouse through your broker that you have the financial capacity to live up to that commitment. Should you get delivered, or should you have to deliver, you have to show that you have the financial capacity to meet your obligation that you're taking on. You don't have to have physical metal that you're lending out or you're borrowing in to cover your short futures position.
Okay, so that's one of the things that causes people grief is that they go, we could squeeze the shorts and the price of the commodity is going to go through the roof because they have to acquire the commodity in order to satisfy their short, when in reality they've already put up that collateral either in the commodity or financial instruments, that they are subject to lose on margin. But it's not, all of a sudden, we have to have a whole bunch of commodity in order to satisfy this.
It's one of the mistakes that Wall Street Silver perpetuated or played on. They were watching people squeeze short in the equity market. And they said, oh, well, these guys, are short and they probably don't have the shares, blah, 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 whatever. So let's do the same thing in silver, not realizing that futures are settled, 99.9% of the futures are settled for cash. And it's very funny because people say, oh, futures ought not to be allowed to be settled for cash. Well, they are, and they always have been, and they were created to allow that. So for you to come along with some Puritan view, like, this is usury or whatever, that's not what the futures markets do. And there is this misunderstanding that, oh, if there are all these longs and they stand for delivery, there's not enough metal to deliver. And the reality is that most futures markets are settled, most futures contracts are settled for cash, always have been, always will be, because that's what their futures markets are all about. They're about buying and selling the exposure to gold price changes, not necessarily buying and selling physical gold.
Yeah, I would take a little umbrage. I think the Puritans would have referred to this as witchcraft rather than usury. But we'll move forward from that point. So you're in an active month. We're going to be going into September here, and it'll be an active month. So there's so many long contracts and short contracts. But as you said, not everybody takes delivery but they have to close these contracts. So again, when there's a misconception that one side of the boat is overloaded versus the other side, it's this delivery mechanism that throws people again, because as we spoke of earlier, they think it's like a game of musical chairs. When the music stops, you better have a seat. But that's not the case. A lot of these contracts just wash out over each other. I've got a long, I've got a short for the same. I take it to the exchange, and they cancel each other out.
Right. I mean, if you look at the gold contracts right now, the active month is December. September, you have, as of yesterday, you had 322,000 ounces of open interest. I'm sorry, you had 3,000. Let me put my glasses on. I apologize. You had 300,000 ounces of open interest yesterday in the September contract. The October is a more active contract, and there you had 5.6 million ounces of open interest. But then the really active contract is the December contract, where you had 33.6 million ounces of open interest. So what you'll see as September becomes deliverable, I guess today and tomorrow, you'll start seeing those 322,000, I'm sorry, 300,000 contracts of September. You'll see the shorts initiate the delivery program, go to the clearinghouse and say, okay, I have short contracts in September, and here, you've got my depository receipts. I'm going to deliver. And then the clearinghouse will assign those depository receipts to people who are long, and they have to put up 100% of the value and buy that gold. So the gold would change hands. It doesn't necessarily move. It stays, most of it stays exactly where it is in the same depository, but the ownership changes, right? There is metal that comes in and out of those depositories because they're working industrial depositories where refiners are delivering refined metal and fabricators are taking out the refined metal on a daily basis. But yeah, you've got like 300,000 ounces. So the shorts go to the clearinghouse. They initiate the delivery process. They say, I'm short September and I'm going to deliver into it. So then the clearinghouse assigns those warehouse receipts to longs, and the longs either buy them or they redeliver them and get rid of them. And that's the delivery mechanism there. And that goes on from the first delivery day, which is the second business day before the beginning of the delivery month, into the end of the delivery month, which is the second last business day of that delivery month, or third last day of the of that delivery month. So September is not a particularly active month. 300,000 ounces, not going to shake the world. 5.5 million ounces in October, that probably isn't going to shake the world. What everybody in the core market is looking at are those 33.6 million ounces in the December contract. And it's very important to understand, August was an active month. And when you went into the August delivery, you had like 30 some odd million ounces of delivery into the August contract. Most of those contracts were not delivered against. I think about 3 million ounces of it was, it was a fraction of it. Most of that was bought back and then sold forward into December. So the 33.6 million ounces of open interest in December didn't exist at the end of July. Most of that was shifted over the course of July and August into the December contract. And it shifted because the people who are short and long Comex futures contracts aren't necessarily interested in taking delivery. They're interested in in price exposure. So if I'm hedging my inventories that I've leased out to manufacturers around the world, I want to maintain that short position on the Comex because my physical metal I still have the exposure to being long physical metal on my portfolio.
So if I understand what you just said correctly, I am a long investor. I've taken somebody's 100 ounces of gold. I've taken delivery of that and immediately have put it up as collateral to take a contract for December.
Right.
So that I've closed out my long September position, and in turn I pushed it out to December by taking delivery of the gold and then putting it into a new contract, pledging the gold that I just took delivery of as collateral to the future long.
That's one way of doing it. Yes.
That's one way of doing it. So ultimately, that's how that process goes. So if I had the short and the long, can I also take it to the exchange and say, I've got this short, this long, and cancel them out over each other?
Yes.
How does that process go?
It's the same way. You go to the clearinghouse, say, I have a short position I want to deliver, and I have a long position I want to take delivery of. So let's just cross these two contracts.
And no money necessarily would change hand in that situation. It would be what, casino people would call a push.
It'd be the depository receipt. So there's a change in ownership. If, again, you remember, the Comex market participant that's working and dealing with the clearinghouse, those may be its contracts for its own principal proprietary book, or it may be its own contracts for its hedge book, for its commercial division, or they may be contracts from two distinct clients. One client was short, one client was long. In that case, the client that's short has delivered its delivery depository receipt to the client that's long. The client that's long now has to prove to the clearinghouse that it can afford to do that.
Okay. So another term that you use that's regularly used that I don't think people really have an understanding of is the term open interest. So when someone's talking about, as you said, there's 300,000 ounces of open interest, is that the total of both the longs and the shorts, or is it measuring one or the other?
It's measuring the number of contracts, which is, it's one or the other. Yeah, you can measure the longs or you can measure the shorts. They always match. And it's the number of contracts. So it's not longs plus shorts. It's the sum total of contracts that are outstanding in that given contract month.
So the market itself can't go out of balance. There has to be an equal number of longs and shorts in any given month.
You
So
know, maybe 50 years ago, before computers got as good as they were, you could have really crazy days where they got out of balance, but then they would stop and they'd clean up their books. I mean, I think this actually happened in the silver market in 1987. There were some really crazy days in late 1987, and the Comex had not really gotten its computerization in order. And there were some people who walked away from their positions, and the Comex had to stop trading for silver for a couple of days while it cleaned up the balance. And then it went to the members and said, okay, you owe this money and you get this money because now we've cleaned up the balance. But nowadays it's all computerized, and it balances out every day. And, again, a lot of the financial intermediaries live on borrowed money too. And the companies that lend them the money to finance their commodities trading business say, I'll loan you this money, but you have to be 100% hedged, at least at some point every day. It used to be at the close of trading, you have to be 100% hedged. And maybe for a lot of contracts, it still is. But at some point during any 24-hour period, you have to be 100% hedged, because we who are lending you the money so that you can trade gold, we do not want you blowing up and not being able to pay us back the money that we've lent you. So the lenders to the financial intermediaries say you have to be 100% hedged, which is another myth that people have, where they think that you have these naked shorts on the Comex on the part of commercial entities. There are naked shorts on the Comex, but those are investors and speculators. The commercial entities almost all borrow money to pay for their business, and their lenders require them to be 100% hedged.
Okay, so let's say I am a naked short and I've used one of these companies. They have to hedge against the risk, but I'm not necessarily hedged against the risk. Is that correct?
No, they will require you to put up margin and to show them financial records so that they can feel comfortable that you can live up to your obligations. So in essence, they have to prove, if you're a naked short, if you're an investor and you say, I just want to be short gold, you have to prove to your broker that you have the financial wherewithal or the physical gold to cover that short position. Or they won't, if you don't do that, they won't fulfill a short contract for you.
So even if there were naked shorts, then they're already covered and hedged out so that they can't basically break the Comex, such has been
They can't break the
suggested.
Comex. They can break themselves, but they can't break the Comex.
Perfect. So I think we have covered all the discussion and the topics that we had set out to cover. So let's summarize this whole discussion really quickly, and hopefully I get the summary correct. But futures markets were essentially created in order to pass price risk on from merchants to investors and speculators. And they're key to making sure that the markets function accordingly and people have price assurances of whatever goods are transported across the markets. You have registered dealers that trade in contracts. They don't trade in the commodities, they trade in the contracts. And whether you're long or you're short in the contract, you have to put up the collateral to make sure that you can fulfill that contract. So it's either in the commodity, treasuries, or cash to be able to do so. Just because you have a contract closing doesn't necessarily mean that it has to stand for delivery. You can take that contract, find the offset of the contract, and then roll that over into another futures contract down the road, because you would take the collateral that you've acquired from closing that contract and simply putting it up onto a new contract. So all this discussion about manipulations and things are just been simply people just not understanding what the market actually is trading in, and comparing a COMEX market to a stock market when they're two completely different creatures. It'd be like comparing a giraffe to a possum. You know, apart from they're both, well, I guess they're probably both not mammals. One's a marsupial as well, but apart from their creatures that are living on the earth, there's not a whole lot alike about them. So have I kind of summed everything up appropriately?
I think you've got it right. I think you've summed it up correctly, you know. And I'll add with a little homage to Teddy Roosevelt. You know, the people who criticize the Comex are sort of like the guys, yeah, you go to a basketball game and you're sitting in the seats up in the arena, and the guy next to you is like ragging about these basketball players. They don't know how to play. What, you know, they're doing this sloppy stuff, blah, blah, blah. They have a very narrow view of what it means to be a professional basketball player and what the strategies are and what the team has worked out, so that if you see so and so in a certain place in the court with the ball, you do this. And if he signals a certain way, you do this instead, you know, and they don't understand all of the minutia that's there. But the guy in the arena, homage to Teddy Roosevelt, who was talking about boxing, the guy on the court, he knows how complicated professional basketball is. The guy in the arena that's a boxer, back to Teddy Roosevelt, he knows some of the mechanics of boxing. The guy up in the state in the bleachers saying that guy can't box worth anything. He's like speaking from a position of incomplete knowledge.
And it could be a bias because he wants the other guy to win.
Or bias too.
Yeah. Wonderful. Well, I really appreciate you taking the time to go through this. As I said, when I talk to people, I hear a lot, and a lot of the things that we addressed today, and it was, you know, they're just simply not understanding how this works, and it's not the same as what they're comparing it to. And it's been a very hard process, at least for me as a layperson, to try and get them to understand that. And I think you've done an excellent job of clarifying these things. But if people
Thanks.
want to continue to follow the CPM group and what you guys talk about on a regular basis, you go with all this knowledge. You actually project what you think the markets are going to do. How would they follow you, Jeff?
We have a website, cpmgroup.com. You can read, there's a lot of free reads and videos and stuff. There's information about who we are, what we do. You can buy our yearbooks from the website. You can send us an email at info@cpmgroup.com. Say, I'd like to talk to you guys about how you might help me. And then we do twice weekly videos that we post on YouTube. So if you go to YouTube and you search CPM Group, you'll get a plethora of videos about a variety of topics. We try to make them educational. We talk about where the markets are going, but we try to bring in a lot of background to help people really better understand the commodities markets and the precious metals markets, and to knock down a lot of the myths and suppositions that you hear circulating in the market.
Yeah, and it's generally, most of the videos are around 20-25 minutes. It's a good bite-sized bit of knowledge that you could get off of those, and I highly recommend people do that. Again, I want to thank you for taking the time to go through this process. I'm sure it's not the first time you've done it, and probably won't be the last time, but hopefully we've educated a few more people.
All right. Thank you for doing it. I mean, we get a lot of these questions too, and we haven't taken the time to do a video on them. So I'm glad that you sort of like forced me to slow down and sit down and explain some of these things once again.
Yes. Again, thank you for your time.
Take care.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.